Most business owners think that tax preparation costs money, but in reality, tax strategy costs you even more money. In this video, I'm gonna show you where business owner lost the money in just tax preparation fee and not doing the strategic tax planning, and what could have been done differently. This was just a client that we just signed up, and the first thing what we typically do when the clients come into our practice, we do this financial audit. So with this financial audit, what we do is we review tax returns for the past 3 years. So in this case, for this particular client, we reviewed his 2023, we reviewed 2024 and 2025. So the good thing is that he didn't file the tax return for 2025 yet because the year just ended and he was able to come to us. But here's what we found in 2023. Doesn't matter, in reality, doesn't even matter about the gross and going into the depth in all the numbers. So I'm just gonna show you by simply looking at two numbers for 23, 24, and 25, where the mistake was and where all this hard-earned money in taxes that were lost by this particular taxpayer. And he had an amazing CPA. So he had a K1 in 2023 of minus $190,000. Then at the same time, he took a W-2 from his company, which was $80,000. Then in 2024, he had a profit of $35,000, and he takes another W-2 as a salary for $80,000. Right, so this year, 2023, just like many business owners, he is looking for the cheapest professional, the cheapest CPA to prepare his tax return, because that's all he is looking. I didn't make any money. Very common what I hear from business owners. I'm losing money, so then I shouldn't be worried about paying taxes. And that's exactly what happened in 2023. So 190,000 loss, 80,000 in profit. So we're talking about he doesn't need to worry about it. He has 110,000 in losses after all. So 2024 comes in 35,000, 80,000 in W-2. So his total income of 115,000. And then now 2025. So in 2025, he is looking at the income of 100,000 in profit, W-2 income of $80,000. So that comes out to a total of 180,000 in a taxable income. So 2025 is he actually, that was one mistake that we found. So he actually did pay taxes. He had $115,000 in income. The taxes were not withheld enough from the W-2, so he had to pay an extra $5K in taxes for that year. So the first mistake that we found, that this loss, even though he had this loss, so it was never actually carried over, because you see he deducted 190 out of the 80,000. He had 110,000. The loss just disappeared. The accountant didn't even carry over the loss. If the accountant would have carried over the loss, then not only he would not pay the 5,000, but all the money that he paid throughout the year on this W-2 of 80,000, he would have been able to recap. Now here's another thing. So now we're looking at 2025. So he has $180,000 in total profit and income. So he has to pay taxes on all of this income. So here's the problem. If the strategy would have been applied, everything could have been done differently. First of all, he didn't even need this loss in 2023. So since he had only 80,000 in W-2 income, he didn't even need the 100,000 in these losses. So have this been done strategically, there's a lot of things could have been done differently. Well, first of all, instead of taking 80,000 in W-2, he could have literally taken just the minimum wage. Because by taking 80,000, he had to pay 15.3% self-employment tax just on this $80,000. So that was already wasted money, which he's not gonna recover. So, and then at the same time, so he could have just literally taken like 40,000, at least half of it, minimum wage, and be done with that. Then at the same time, he didn't even need the whole 190,000 in losses, because as you see, he's not even getting any benefit. And even if he would be getting benefit, he's in such a low tax bracket, so it's just a wasted money. So now going back to this year, 2024, you see again, like if this whole thing wasn't structured in the right way. Again, here he could have taken the minimum wage in a salary and then saved this 15.3% tax on $80,000. At the same time, instead of having this $35,000 in profit, he could have just breaking even to the zero. So in reality, this whole $100,090 in this loss could have been spread out throughout these 3 years. And then this year, now that he has $180,000 in profit, all of this could have been offset with this loss that he had in 2023, would have everything been done strategically, and planned strategically. But now for him being single, so now he has to be, besides paying this 15.3% in Social Security Medicare taxes at the same time, so now he is in a 22% tax bracket, so he has to be paying federal tax as well as the state tax and as well as the New York City tax. So if you live in New York State and New York City, you also have to pay the, even though you have an S-Corporation, you have to pay the city tax, the corporate city tax, personal. So there is like, just on this 180,000, he is looking to pay like close to $60,000. So would have, and this is the loss, would have all of this done differently 23, 24, then the $60,000 he could have saved versus paying them right now. So this is just simply, without even going into all the deductions, different strategies, depreciations, paying kids, or any other strategy. This is just one simple step that could have been done different. If you would like for us to review your books and see if there is anything that you could have done differently, it's still not too late, especially right now we are at the beginning of the tax season and there's still time to review your books, to implement the strategies. And remember guys, financial freedom is all in your hands.